Thank you very much. And thanks everyone for attending this session. Yeah, I think the previous session is quite insightful, but I realized that our ETF unfortunately is still not on the recommendation list. So that's why I myself have to talk about this ETF, to talk about the potential opportunities into the S-REITs, these evergreen investment strategies in Singapore. But it doesn't mean that the recommendation is not good. They're quite good, but ours is also quite good and different from the others. And if you look at this page, it's actually made by our investment advisors back to 2 to 3 years ago. And now most of the major factors have been moved in line with our expectations, such as the peak of the SG&A cost and the peak of the inflation, together with the early signs of the easing stance from the MAS and also the US Fed. But there's one factor which is actually against our anticipation. That is the red arrows, the economic growth, partially because of the slower global growth due to this global tariff war. So even Singapore is not immune to this tariff war. For example, the MTI narrowed the Singapore growth by 1% to 0 to 2% for this year. And on a forward-looking basis, the business sentiment also have weakened. And over the past several months, if you look at the top right charts, there are also some front loading from the Singapore exports to the US and similar to the regional economies, which means perhaps only till the start of the third quarter this year, we just start to feel the negative impact from the global tariff war. And of course, as compared to the other economies in ASEAN, Singapore has the lowest US tariff rate, it's just around 10%. But given the high value added to US imports as compared to the Singapore GDP, which is almost 9%, Singapore is still a bit vulnerable to slow down in terms of the exports to the United States. So that's to some extent explain why the easing expectation is there, the cost is peaking, but we still just see a 3% plus growth in terms of the year-to-date REITs performance. But on a positive note, even in the US, the inflation is still a problem, but at least in Singapore, the inflation is easing, partially because of these, the lower core inflation, except for the transportation, of course, and partially because of this moderation of these labor cost. And also, in the meantime, we can see that at the bottom, there is also some flush liquidity in Singapore, as indicated by the low loan-to-deposit ratios. And that's why, according to the Citi's estimates, year-to-date, MS perhaps has already been reducing their Singapore dollar near slope by around 100 bips. And more importantly, as shown on the bottom right, we finally see the short-term Singapore rates have gradually grinding lower, which is diverging from the US interest rate, which is at least high for longer in the near term. But even for the US Fed, of course, there are still some uncertainties about the number of cuts if they are going to cut for later this year. But the market consensus is that it's highly likely that the Fed cut will restart, let's say, in September this year. I think that's good enough. And if the MS will also follow the similar easing stance, at least for those S-REITs with large overseas revenue exposures, their offshore earnings dilution will finally, from the previous stronger Sing dollar, will finally dissipate, which means they will earn more in terms of the Sing dollar. And also, even before the cut cycles, or restart of the cut cycles, the S-REIT's debt of cost is anyway peaking since the third quarter last year, which means the newer debt they incurred for this year is already 250 bips lower than their peaks around 3 years ago. And the MA's recent loosening of these, let's say, the leverage limits can also leave more cushion for those S-REITs to add more to add more, let's say, the AEI or the M&A activities. For example, regardless of your interest rate coverage ratio, any underlying S-REITs, they can have at least 45% gearing ratio. And if your ICR ratio is more than 1.5 multiple, then your debt to asset ratio can be raised to up to 50%. And the divestment industry can also be interesting because we do see a positive yield carry, which means for those S-REITs, they divest some of their existing assets, their yield is positive versus their purchase price. And there are two implications here. One is that the positive yield carry will at least relieve some pressures for their existing balance sheet. And secondly, after the divestment, they can use their funding to do more value-add AEIs and also the merger and acquisition activities. And from rental reversion, generally speaking, they're still quite okay, but tapering a bit and also diverged between different sectors. For example, in terms of the retail REITs, the shopper traffics are still mixed between the different issuers, but overall speaking, the rental reversions are still at a double digit. And in terms of the office REITs, the average rental reversions is still manageable at a high single digit, similar to the industrial REITs. And in country, the hotel REITs, the RevPAR are still under great pressure, but this is also not surprising because the Singapore hotel REITs is also one of the most expensive in the world. Imagine the hotels here, right? But the good part is that the recent earnings revisions have already priced in a lot of negatives. For example, the previous debt pressure, the previous inflation pressure, and also the recent fundamental change, which means when we see a turn in the interest rate again later this year, even the fundamental hasn't changed, we may see a very quick turnaround in terms of the S-REIT price. But of course, the fundamental, it takes longer time to recover. And from a valuation perspective, it's very clear because historically, we conduct analysis. When the S-REITs are traded at PB at 0.8 to 0.85 range, we see a very, very strong support level. There's no exception. But the good news is that now the S-REITs PB is just 0.87, which means the downside is perhaps a relative limit, but the upside potential are still there, even considering the June and July rebound. And yield spread can provide a very similar conclusion because as of June 20th, the dividend yield of S-REITs, 6.4%, very attractive from absolute level. And on a relative basis, it also provides more than 4% pickup versus the risk-free Singapore 10-year yield. And even you use more recent years valuation data, it can still show that the June 20th PB level is relatively attractive versus the recent 7 years history. And as compared to the region's other REITs, Hong Kong, Japan, Australia, even the US and UK REITs, the 4% yield pickup are still also really attractive. So if we believe following the next round of the REIT cut cycle, the global REITs outperformance or performance, they can just begun, this cycle just begun, then we should have a strong reason to see the dark blue line, the Singapore S-REITs should have a chance to catch up with their global and regional peers. And also, as compared to the Singapore equities, or particularly for the Singapore banks, over the past several years, the performance gap has been widened to 50% or even 66%, as perhaps the historical wide level. So if the interest rates finally go down again, then we do believe this gap will narrow or even reverse, so which imply a good chance. And by sectors, we just want to highlight the supply and demand dynamics. And as for the industrial REITs, except for certain factories and some business parks, overall speaking, the supply demand is still manageable. So that's why the average industrial rents are still ticking up over the past several years. And for office, of course, in the upcoming several years, the supply is increasing. But overall speaking, the net new supply is still below the past 10-year historical net demand. And this is particularly true for the central area on the bottom left, which means which implies still increasing grade A rents of the Singapore office rent. And similarly, the net new supply in terms of the retail REITs is also below the 10-year historical net demand. And more encouragingly, on the bottom left, both the Orchard Mall REITs rents and also the suburban mall REITs, they both see some gains over the past several years. And even for the hotel REITs, the RevPAR is still under pressure. In terms of the visitor arrivals this year, are still expected to reach to around 17 to 18.5 million for the whole year, which is up 3 to 12% year over year, which means they can at least plot a bottom line for the hotel REITs growth this year. And this is our SRT's benchmark, the SGX IHS Leader Index. I want to repeat these methodologies in too much details, but we just want to highlight our benchmark include the 21 largest and the most liquid S-REITs traded on SGX. And to avoid some concentration risk, we kept each individual stocks at 10% during the rebalancing date. So the net result of our portfolio is a very balanced portfolio, including the cyclical names like the office, retail, and hotel REITs, and also some defensive REITs like the industrial data centers and some healthcare REITs. And in terms of the country breakdown, 60% are still Singapore business, which is quite a main beneficiary of these lower SORA rate, and the rest 40% is in the APAC and even in the US and Europe regions. And again, sometimes, actually, before this session, I talked to some of our investors at our booth. Someone said, okay, our ETF is not quite large, and liquidity is also not superb on the SGX. We agree, but in terms of the underlying investment we made, as you can see here, 85% of the weight is already made by our top 10 holdings. And all these holdings are mainly owned by let's say, the largest sovereigns like Temasek, and also the sponsors and one of the largest asset managers in the world, which means as long as our underlying investments liquid, we are confident to provide a liquid ETF exposure to our investors. And as of end of June, our ETF's AUM is more than 90 million, and for most of the Singapore investors, they can use the SRT, the SGD counter, to trade it on exchange. The unit is just one, which means the cost is just less than $1. But for some retail investors, we would like to invest in more, and also would like to avoid a wide spread on the exchange. They can also consider the primary creation, and the minimum size is just 50,000 units. It's also not quite high. 50,000 actually equivalent to roughly 35,000 Sing dollar, which is also quite reasonable. And use the primary creation to have the exposure to the S-REITs, SRT, can also give investors a very, very tight spread. So in SGX liquidity is no longer important, but the S-REITs liquidity is more relevant. And again, our dividend payment frequency is semi-annual, which means our next dividend payment will happen in August, and the ex-dividend date will be the third week or fourth week of July. So for investors with shares or plan to invest in this SRT, as long as you invest before the ex-dividend date, you will be subject to the dividend payment. And fees is capped to 60 bips per annum. And the good news is that in history, we managed to outperform our benchmark by almost nearly 60 bips, which means when investors invest in this ETF, SRT, they barely pay nothing to get the exposure of the largest and most liquid S-REITs. And from an absolute return perspective, over the 1 year, it gives investor nearly 9% total return. But year to date, their total return is just around above 3%, which means if we see more cuts from the Fed, we still have some potential to see a further rally of the S-REITs. And lastly, for my slide, since our SRT listing in November 2021, although the market is highly volatile, which impact the SRT's price, the index or the portfolio dividends are really decent and stable, which means over the past 4 years, the average dividend is around 6%. And the most recent indicated dividend yield is close to 2.3% annualized. And this is also a good reference of our upcoming dividend payment. So that's pretty much for my presentation. So we will leave 5 minutes more for the next session. But if you have any question about the SRT performance, their liquidity, and also their dividend yield, we are happy to discuss after this session. Thanks very much.